Welcome to this explainer. Today, we're taking a highly focused dive into ASC 235, specifically, the notes to financial statements. Look, if you've ever grabbed a company's financials, flipped right past the text, and jumped straight to the bottom line, you're missing the actual story. We're setting the stage right here, right now, for why mastering the true regulatory role of financial statement notes is absolutely critical. This isn't just about formatting or making things look pretty, it's about the fundamental integrity of financial reporting.
Let's get right to the core of it. The rule under US GAAP is incredibly clear. The notes to the financial statements are an integral part of a complete set of financial statements, not an appendix or optional supplement. People so often treat notes like the fine print at the bottom of a software update. You know, that cosmetic afterthought you just scroll past to click accept. But that mindset, fundamentally flawed. If you ignore the notes, you are literally ignoring the financial statements themselves.
So here's our quick roadmap for today's explainer. 1. Notes are not optional. 2. The 6 required components. 3. Foundation, the SSAP. And 4. Avoiding the boilerplate trap. Let's get into it.
Section 1. Notes are not optional. Let's talk about the real cost of missing context. You see, the primary statements alone give you the hard numbers, sure, but they're an incomplete story. Treating notes as an afterthought is genuinely dangerous. Under US GAAP rules, a missing or incomplete note isn't just a typo. It triggers a strict domino effect. Step 1, you have a missing or incomplete note. Step 2, boom, that triggers a recognized accounting deficiency. It's a straight-up failure of compliance, which leads directly to Step 3. An auditor qualification or a material weakness. It is a strict, undeniable cause and effect sequence.
And the sheer variety of crucial context users rely on these notes to provide is huge. This is the stuff the primary statement simply cannot convey. For instance, revenue recognition. How exactly is the company recognizing its revenue? When? At what rate? What about depreciation methods and useful lives? A balance sheet shows you the dollar value of assets, right? But the notes tell you how long those assets are actually being depreciated and by what method. What about debt terms and covenants? Or what if there are massive contingent liabilities hanging over the company, like a pending environmental lawsuit? And absolutely crucial for any analyst, what about the critical accounting estimates where management had to use heavy judgment? Without this context, an analyst, an investor, or a regulator is just flying blind.
Moving on to Section 2, the 6 required components. Where exactly do notes fit in?
Under US GAAP, a complete set of financial statements for an annual period includes 6 distinct components. You've got your balance sheet, showing the financial position at a point in time, the income statement, showing operations, you have the statement of comprehensive income, the statement of changes in stockholders' equity, and the statement of cash flows. But here's the critical point. That 6th pillar? The notes to the financial statements. They contain all the disclosures required to ensure those other 5 statements aren't misleading. The notes are completely equal in standing. They are not subordinate to the numbers.
Section 3, Foundation, the SSAP, which is really the bedrock of disclosure.
So if we zoom in from the general notes, the SSAP, or the Summary of Significant Accounting Policies, is typically the very first note a reader sees. By definition, it describes all the significant accounting policies the entity has adopted to prepare its statements. It's the essential key that unlocks the reader's understanding, because it tells you exactly how each major line item on the balance sheet and income statement was actually measured and recognized. Without the SSAP, those numbers are just floating data points without an anchor. But what actually makes a policy significant enough to make the cut? Well, first, did management make a selection from acceptable alternatives? Say, did they choose the FIFO method or the weighted average method for inventory? That single choice completely changes the profit picture, so yeah, it must be disclosed. Second, does the measurement approach involve material judgments, like calculating the allowance for credit losses? Third, is it simply any method a reader would need to know to make sense of the financials? The golden rule here for any preparer is super simple. When in doubt, include it. It's always better to over-disclose an accounting policy than to leave the reader completely guessing.
And how should this bedrock note be structured? Well, the SSAP typically follows a very logical, chronological format. It mirrors the exact order of the financial statements themselves. You start with general matters, like the basis of presentation and consolidation rules, and then you move sequentially right through the balance sheet and income statement items in the exact order they appear. It's like a map, guiding the reader smoothly and concisely through the financial narrative without making them jump around.
Section 4. Avoiding the boilerplate trap. It's all about describing reality.
Let's talk about the most common weakness auditors see. Consider the lazy approach versus the compliant approach. The wrong way? Simply copying the prior year's boilerplate generic policies without updating them for your current reality. Look, if you adopted new standards or had new types of transactions, last year's text is now an accounting deficiency. The right way, the fully compliant way, is describing what the entity actually does. Your SSAP has to reflect your real-world, current practices, not what some generic, hypothetical company might do. The notes are about describing reality.
So, let's wrap this up. We've built the bedrock in this explainer today. You now know why the notes are the equal sixth pillar and how the SSAP unlocks the how of your financial numbers. But I want to leave you with a provocative question. You know the foundation now, but when you look at your own company's disclosures, are your specific policies actually compliant, or are they just copied and pasted boilerplate? We've laid the groundwork, and this sets us up perfectly for our next lesson, where we'll dive into every specific policy requirement to ensure your SSAP is completely bulletproof. Thanks for joining me on this explainer, and I'll catch you in the next one.